Hello everyone, let me introduce myself. I'm Adika Saputra Lubis with NPM 234111097 from Management Class 23X. On this occasion, I will explain the material related to financial institutions. Financial institutions are business entities or institutions that are engaged in financial services, play a role in providing financial services, collecting funds from the community, and channeling them back to support various economic activities. In addition, financial institutions also help maintain the circulation of money in the economy while earning profits in the form of interest or percentages. Financial institutions carry out various business activities, such as providing financial services, offering loans, and capital participation. However, in their operations, financial institutions generally only focus on one or two types of business activities. Examples of how to raise funds conventionally include the provision of saving services, while examples of fund distribution include the provision of credit or loans. The process of establishing a financial institution must follow the procedures in accordance with applicable laws and regulations. The Financial Services Authority and related institutions also supervise the activities of financial institutions. Strict regulation and supervision are needed to create a healthy and safe financial services industry for the community. Financial institutions include various business operations in the financial services sector, such as banks, trust companies, insurance companies, brokerage companies, and investment traders. In Indonesia, financial institutions are divided into two main categories. First, bank financial institutions, and secondly, non-bank financial institutions, which include insurance companies, pawn shops, pension funds, mutual funds, and stock exchanges. In general, financial institutions have an important role in the modern economy because they function as an intermediary between parties who have surplus funds and parties who need funds. Financial institutions provide services that help various community groups. This is because financial operations are an important element in every economy. Both individuals and companies are highly dependent on financial institutions to carry out transactions and investments. Financial institutions have various functions that are closely related to people's daily lives. Its existence has a positive impact on the community, thus improving their quality of life. Although each type of financial institution has a different function, in general there are several functions that apply to both bank and non-bank financial institutions. 1. Provide security assurance and money storage. 2. Provide information to customers. 3. Launching product exchanges that use credit and cash. 4. As a transaction tool for all activities. 5. Providing financing for business and consumptive needs. Based on the type, financial institutions in Indonesia are divided into two types, namely bank and non-bank financial institutions. 1. Bank financial institution. Bank financial institution, depository financial institution, is a financial institution that provides banking facilities and services for the community, both in storage, payment, and giving funds. Simply put, a bank financial institution is a financial intermediary institution established with the authority to receive and collect money deposits, lend money, and issue banknotes. 2. Non-bank financial institutions. Non-bank financial institution, non-depository financial institution, or non-bank financial institution, LKBB, is a financial institution that carries out the process of raising funds by issuing securities. In addition, non-bank institutions also provide various financial services and attract funds from the community by deposit or indirectly. Example of bank financial institution. 1. Central bank. 2. Commercial bank, public bank. 3. Bank per Credit and Rakyat, BPR. Examples of non-bank financial institutions. 1. Insurance company. 2. Pegadaian. 3. Capital market. Benefits of financial institutions. 1. Make transactions easier by becoming cross-payment. 2. Provide cash with withdrawal via ATM. 3. Transferring assets to gain profit. 4. Relocation of income for future use. The role of financial institutions in the economy. Financial institutions such as the central bank have a role as a rupiah printer, which is used as a legal means of payment, with the aim of facilitating financial transactions among the community in the macroeconomy of a country. Commercial bank financial institutions have the duty to issue checks that are useful to facilitate transactions made by customers. Financial institutions can also act as brokers, or dealers who are tasked with increasing efficiency between both parties and customers. Financial institutions also play a role in helping the distribution of funds from the household sector to borrowers, indefinitely and without being known by the fund owner. Transaction costs and information costs themselves are lower compared to if the borrower has to find and do the transaction directly. Financial institutions also have a role to reduce the risk of loss that may be experienced by fund owners or savers. The loss in question is that the customer's savings are not paid back, where this will not happen because of the financial institution's strategy in managing various fund allocations. These are the videos from me related to financial institution material. Thank you for watching.